Your next reading is Portfolio Risk and Return, Part 1, and we have end of chapter questions. An investor purchased 100 shares of a stock for $34.50 per share at the beginning of the quarter. If the investor sold all the shares at $30.5 per share after receiving a dividend of $51.55 at the end of the quarter, the holding period return is closest to. We know the holding period return is equal to ending value minus beginning value plus asset income, whatever interest or dividend we may have received over the period, divided by the beginning value. Now, if you just plug in the numbers and you'll get your answer. So ending value was 30.5 times 100, that is 3050. The beginning value was 34.50 times 100, that is 3450. And the income that we have earned over the period was in total, it's not on per share basis, clearly 51.55 is the total dividend payment over the quarter, and then divided with the beginning value, which is 3450. Now, if you simplify this, this would give you negative 11.59%, and that makes B to be the correct option. Next, an analyst obtains the following annual rates of return for a mutual fund: 2008 14%, 2009 minus 10%, and 2010 minus 2. The fund's holding period return over the 3 years period is closest to. See, the fund has increased by 14% in the first year, fell by 10%, and then again fell by 2%. So we can do it in a straightforward way. We can write it the way 1 plus 14% times 1 minus 10% times 1 minus 2% and minus 1. So when you will simplify this part, it will give you 1.00548, and from this if you deduct 1, what you will have is 0.00548, and if this is expressed in percentages, it will be approximately 0.55%, which is B. B is your right answer. Next, an analyst observes the following annual rates of return for a hedge fund: 2008 22%, 2009 minus 25%, and 2010 11%. The hedge fund's annual geometric mean return is closest to. I'm sure you would have gone through the reading video. How do we do that? 1 plus 22%, 1 minus 25%, and 1 plus 11%, raised to the power 1 by n, that is 3 years period, so it's going to be 1 by 3 minus 1. Okay, now if you simplify this part, you will get 1.0157 raised to the power 1 by 3, and minus 1. If you deduct 1 from this, you should get 0.0052, which if expressed in percentages would be 0.52%, and that makes A to be the correct option. Next, which of the following return calculating method is best for evaluating the annualized returns of a buy and hold strategy of an investor who has made annual deposits to an account for each of the last 5 years? Since we are interested in the returns only, we should go for geometric mean return, because the geometric mean return, it compounds the returns instead the amount invested. So this would make A to be the correct option. Next, an investor performs the following transactions on the shares of a firm. At T0, she purchases a share for $1,000. At T1, she receives a dividend of $25 and then purchases 3 additional shares for $1,055 each. At T2, she receives a total dividend of $100 and then sells the 4 shares for $1,100 each. The money weighted rate of return is closest to. Okay, now so to calculate the money weighted return, we need to find that particular discount rate that would sum the present value of cash flows to 0. So we have 3 cash flows. Let's first see. At year 0, we invest 1,000, that is negative. Then at T1, she receives $25, which is positive, and at the same time she purchases 3 additional shares at the rate of $1,055 each. And if you calculate 3 times 1,055, 3 times 1,055, and deduct, and this is a negative number, mind it, and to this add 25, what you get is negative 3,140. And then at the end, T2, she receives a total dividend of $100, plus then she sells the 4 shares which she had at 0, and then 3 these. So these 4 shares at $1,100 each. So the total money she will receive at the end of year 2 will be $4,400 plus 100, that is $4,500. So these are the 3 cash flows, and we just simply need to find the IRR. So you can use the TVM and discounting function of your financial calculator, so you will be able to calculate this quite easily. So let me write this down. So your cash flow at year 0 is negative 1,000. Your cash flow to year 1 is negative 3,140, and the cash flow at the end of year 2 is 4,500. So when you use the TVM, you will get your IRR, which would be approximately equal to 6.91%. So that gives you B to be the correct option. Next, a fund receives investments at the beginning of each year and generates returns as shown in the table. Year of investment 1, 2, 3. Asset under management at the beginning of each year 1,000, 4,000, 45,000, and the return during each year of investment 15%, 14%, and negative 4%. Which return measure over the 3 years period is negative? Okay, so let us first calculate the geometric mean return. It is equal to 1 plus 15% into 1 plus 14% to 1 minus 4% and raised to the power 1 by 3, because there are 3 periods involved, and then deduct 1 from the total value. So if you do, you will get 7.97%. So it is positive. Time weighted return of the fund is the same as the geometric mean return of the fund. So it's again 7.97%. Now that leaves only the option C, and of course that would be the right answer. But let's do the computation. They are long, they're a little twisted, but let's do them so that we make a better understanding. Okay, so this would be the working balance from the previous year, nil. Okay, new investment $1,000. Okay, net balance at the beginning of year 1, of course, 1,000. But at the end of year 1, there is return during the year investment 15%, which means we earned 15% of 1,000, that is 150. Right? So investment return for the period was 15%. So investment gain was $150. Balance at the end of the year, 1,000 plus 150, that would be $1,150. Now this $1,150, the balance at the end of the year would be the opening balance for the second year. Now what is the asset under management at the beginning of each year? That is 4,000. So if 4,000 represents the balance at the beginning of each year, so that would mean the additional investment would be the difference between this and this. That would be $2,850, right? So the return generated during the period was 14%, and 14% of 4,000, that would be 560. So what will be the balance at the end? 560 plus 4,000, that will be 11.4560. This would be the balance from the previous period, right? And what is the net balance at the beginning of the year? 45,000. The difference between these two would be the new investment. And if you calculate the difference between 45,000 and 4560, that would be 40,440, right? And since the return has been 4% negative, that would mean 4% of 45,000, that is negative 1,800. Thereby leaving the balance at the end 45,000 less 1,800, that is 43,200. So in order to calculate the money weighted return, you need to take your relevant cash flows. Your cash flow at year 0 is negative 1,000. That's one. Your cash flow at the end of year 1 is negative 2850. Initial investment, second investment after 1,000. And then 4440, that is the cash flow at the end of year period 2, that is 4440. And finally, the value of the total investment at the end is 43,200. Positive. This is negative as well. So if you take these cash flows and you compute the IRR, you would get negative 2.22%, and that would make C to be the correct option. Which return measures over the 3 years period is negative? Money weighted rate of return. This is quite similar calculation we did in the previous question. So that is it. Next. Okay, at the beginning of year 1, a fund has 10 million under management. It earns a return of 14% for the year. The fund attracts another 100 million at the start of year 2 and earns 8% for that year. The money weighted rate of return is most likely less than the time weighted return, more than or same. Let us first calculate the time weighted rate of return. Time weighted rate of return is simply equal to 1 plus 14% time 1 plus 8% square root of 1 by 2 minus 1, and if you do the simple computation, you will get 10.96%. So this is your time weighted return. Now let us calculate the money weighted return 0, 1 and 2. So initially you invested 10 million, then you invested 100 million, and all this grew up at the rate of 14 and 8 together. Let's do that. 10 times 1.14, that gives you 11.4 million. We added another 100 million to it, that gives you 111.4 million. That grows at the rate of 1.08 to give you the closing value of the fund at 120.312 million. So this is going to be plus 120.312 million, right? Now these are the cash flows, CF0, CF1 and CF2. You just use the financial calculator and calculate the IRR. I'm sure you know what to do. When you do, you will get your IRR, the money weighted rate of return, to be 8.53%. So that makes which to be the correct option. The money weighted rate of return is most likely less than the time weighted rate of return. This is the time weighted rate of return, this is money. So that makes A to be the correct option. An investor evaluating the returns of 3 recently formed exchange traded funds gathers the following information. ETF 1, time since inception 146 days, return since inception in percentages is going to be 1 plus 4.61%. How many days are there in a year? 365. And how many days since inception? 146. Simplify this and deduct 1 from it. You would get the annualized rate of return of 11.93%. Then ETF 2, time since inception 5 weeks, 1 plus 1.10%. How many weeks are there in a year? 52. How many weeks since inception? 5. And then simply deduct 1 from it. You will get 12.05%. Then last one, ETF 3, 15 months, 1 plus 14.35%. How many months are there in a year? 12. Months since inception, 15. Minus 1 would give you 11.32%, which means the ETF with the highest annualized rate of return is your fund 2, ETF 2. That makes B to be the correct option. Next question. With respect to capital market theory, which of the following asset characteristics is least likely, mind the word, is least likely to impact the variance of an investor's equally weighted portfolio? Okay, now the return on the assets, they are not used to calculate the portfolio variance. What we do use is the standard deviation of the asset and the covariances of the asset with the other assets in the portfolio. So that makes B and C to be a part of the computation, not A, and that's why A is least likely and our correct answer. Next. A portfolio manager creates the following portfolios with security 1 and 2 with the weight being 30 and 70 and expected standard deviation 20 and 12%. If the correlation of return between the two securities is 0.4, the expected standard deviation of the portfolio is closest to. We know the formula. The expected standard deviation of the portfolio is equal to square root of the weight of the first security, 0.3 squared, times square of the standard deviation of the first security plus weight squared times standard deviation squared plus 2 times of the weight of the first security times the weight of the second security times the standard deviation of the first security times the standard deviation of the second security. So if you do the computation, you will get approximately 12.11%. Straightforward question. You just need to apply the formula, and that makes C to be the correct option. Next, a portfolio manager creates the following portfolio with security 1 and 2. These are the weights. I think this is in continuation to the previous question. Yes. But this time we are required to calculate the standard deviation when we have been given the covariance. So just a little change in the formula. Do the same thing. Weight squared times standard deviation squared plus weight squared times standard deviation squared plus 2 times weight of security 1 times weight of security 2 multiplied by the coefficient of correlation, which is negative 0.0240. And if you just simplify this by converting this into 0.3, 0.2, 0.7, 0.12, 0.3 and 0.7 and doing all the computation, you will get 2.4%, and that gives you A to be the correct option. Next question, number 12. The portfolio manager creates the following portfolio. It is in continuation to the previous question. If the standard deviation of a portfolio is 14.4%, the correlation between the two securities, since the weight of the security 1 is 30% and the weight of security is 70%, and the expected standard deviation is 20 and 12% respectively for 1 and 2. So if you just simply calculate the weighted average, it's going to be, well, it's going to be 6% here and 70% of 12, that is 8.4%, and adding these up we will have 14.4%. So that is only possible if The correlation between the two securities is +1. That makes C to be the correct option. Alright, if the standard deviation of the portfolio is 14.4%, the covariance between the two securities, and we just did it in the previous part, the standard deviation of the portfolio 14.4% is only possible when the correlation coefficient is 1, right? So the covariance between the two securities, we know how to find the covariance between two securities. Security 1, security 2 is equal to the coefficient of correlation multiplied by the standard deviation of security 1 and the standard deviation return of security 2. So just plug in the numbers. Correlation coefficient 1 positive, 20% and 12%. So if you do the simplification, you will get 2.4%, which is basically 0.0240. That makes B to be the correct option. The following information relates to the questions 14 to 17. An analyst observes the following historical geometric returns: equities, corporate bonds, treasury bills, inflation. 2.1. The real rate of return for equities. We know the formula: real rate of return is equal to 1 plus the nominal return upon 1 plus inflation. And if you just do the simplification, and deduct 1 from it, of course, it'll give you approximately 5.8%. So that makes B to be the correct option. Next question, number 15. The real rate of return for corporate bonds is closest to, same thing, 1 plus the nominal rate 6.5% upon the inflation rate 2.1%, and then simply deduct 1 from it, and that will give you 4.3%. Fairly straightforward question. That makes A to be the correct option. The risk premium for the equities is closest to. Well, how do we calculate the risk premium? That is 1 plus the nominal rate divided by 1 plus the risk-free rate, which in our case is given as 2.5%. And then deduct 1 from it. So what you get is 5.4%. That is A. Next question, 17. The risk premium for corporate bonds is closest to. Do the same thing. 1 plus 6.5% upon 1 plus risk-free rate, that is 2.5%, and then deduct 1 from this. And if you simplify, you'll get 3.9%. So this will be the risk premium for corporate bonds. That makes B to be the correct option. Then we have question number 18. It says, with respect to trading costs, the liquidity is least likely to impact which of these? Stock price? Yes. Liquidity impacts the stock price. Bid-ask spreads? Yes. Liquidity impacts the bid-ask spread. We know that. Then it doesn't affect brokerage commission. Why? Because brokerage commissions, they are agreed upon with the brokerage firm. So this is least likely to be impacted. That makes C to be the correct option. Next. Evidence of risk aversion is best illustrated by a risk-return relationship that is negative, neutral, or positive. This is it. This is about nearly 70-80 years data. It shows that there is a positive correlation between risk and return. Higher risk, higher return. Look at this. The highest risk, 33%, gives you the highest return. So historical data over a long period. This is, as I said, is about 80 years old data. This data indicate that there exists a positive risk-return relationship, and of course which clearly shows the investor's risk aversion. Higher the risk, more expectation for a higher return. So that makes C to be the correct option. Evidence of risk aversion is best illustrated by a risk-return relationship that is positive. C. With respect to risk aversion, or with respect to risk-averse investors, a risk-free asset will generate a numerical utility. That is, this is how we calculate utility. Expected return minus 1 by 2 risk aversion times the variance. Now, with respect to risk-averse investors, a risk-free asset will generate a numerical utility that is Since a risk-free asset has a zero variance, so it doesn't matter whether the investor is risk averse or risk seeking or risk neutral, it will be same for all. Utility would be same for all, right? That would make A to be the correct option. Next, with respect to utility theory, the most risk-averse investor will have an indifference curve with the most convexity, smallest intercept values, and greatest slope coefficient. Let me show you. The investor with the highest risk aversion will have an indifference curve with the greatest slope. As you can see, this one has the highest slope, so that would make C to be the correct option, greatest slope coefficient. That makes C as our answer. Next, with respect to an investor's utility function expressed as U is equal to ER1/2 risk aversion variance, which of the following values for the measure for risk aversion has the least amount of risk aversion? Remember, a negative value in the given utility function, that would indicate that the investor is risk seeking, right? And the positive would mean that the investor is risk averse, and a zero would mean that investor is risk neutral. So that makes A to be the correct option. A negative value would indicate that the investor is a risk seeker. Next, a financial planner has created the following data to illustrate the application of utility theory of portfolio selection. There are 4 investments with the expected returns given and the expected standard deviation. Okay. A risk neutral investor is most likely to choose which of these investments? When the investor is risk neutral, his risk aversion is 0. So we know the utility function -1/2A and the variance. Since the risk aversion is 0, so that will make this factor equal to 0. So that means the utility would be equal to the expected returns. So in this case, this is the highest investment. 3 is the right option. There is no need to incorporate standard deviation since the risk aversion is 0. Hence, the decision is entirely upon the expected return. So out of these, the highest return is from investment 3. So he will go for investment 3, and that is our option C. And C is the right answer. Next, a financial planner has created the following data. Same question. If an investor's utility function is expressed as this and the measure of risk aversion has a value of -2, the risk-seeking investor is most likely to choose which of these investments? Okay, so let us write down our utility function right here. -1/2, risk aversion -2, 1/2 into -2, and of course these are the standard deviations, so it need to be squared. Remember, they are in percentages. Okay, now if you simplify these for investments utility function, for the first one you will get 18.04%. The second one would be 19.64%. The third one would be 22.25%. The fourth one would be 27%. Now out of these, the option that is giving you the highest utility would be option investment 4, that is option C. Correct. Now, just this, in this question, you have to take the risk aversion as +2. So we have already made up the relevant information here. So what we will do, take this as a +2 now. Risk aversion is now positive. Now if you, let me just erase this. So 18 minus less this part, and you will get 17.96% for investment A, 18.36% for investment 2, For 3 it's going to be 17.75, and for the fourth one it's going to be 9%. So the one that is offering you the highest utility is investment 2. Question number 25. Investment 2 is the right option. That's B, and B it is. Now, here it says that what if the risk aversion has a value of positive 4? So we'll use the same layout. Here we'll just simply replace 2 with 4. 4, 4, 4, and 4. Everything else is the same. And now we will simplify, and if you do the first, and for the first investment, utility comes out to be 17.92%. For the second one, it's going to be 17.72%, 15.5%, and for the last one, interestingly, it will be 0. So the one that is giving the highest utility is your investment 1. Question number 26. Investment 1. So that makes A to be the correct option, right? With respect to the mean variance portfolio theory, the capital allocation line is the combination of the risk-free asset and a portfolio of all risky assets, equity securities, and feasible investments. Let me show you. Okay, so this is your capital allocation line. A capital allocation line is basically a combination of risk-free asset and the portfolio of all risky assets, the combination of risk-free asset and risky assets. And that's what gives us a set of feasible investments. So the question required that capital allocation line combines what? Risk-free asset and a portfolio of 3 options were given: risky assets, equity securities, and feasible investments. So we would take the one that says risky assets. Here we go. So that makes A to be the correct option. Next, 2 individual investors with different level of risk aversion will have optimal portfolios that are on the capital allocation line. Not below, not above, on the capital allocation line. That is from our overview video. The straightforward B is the answer. Next, we have a set of questions 29 to 31. The following information relates to question 29 to 31. A portfolio manager creates the following portfolio: security 1, security 2, expected return on security 1 16%, on 2 12%, and expected standard deviation 20% on both. If the portfolio of the 2 securities has an expected return of 15%, the proportion invested in security 1 is, okay, let's say the proportion invested in security 1 is W1. That would mean the remaining proportion that is invested in security 2 would be 1 minus W1. Like if you invested 60% in security 1, that would mean you have invested 40% in security 2, 100 minus 60, right? So that's the idea. You'll just draw up the equation. We know it's going to be expected return is equal to weight 1 and the return on security 1, weight of security 2, returns of security 2. So expected return is given as 15%. Weight 1, we just call it W1, return 1, that is 16%. And weight 2 is going to be 1 minus weight 1 times return on security 2 is 12%. And then there is just simple arithmetic. Let's do it. 15%, W1 16%, then we have 12% less W1 12%. Okay, what you can do, 15 minus 12, that gives you 3%, and W 16%, W1 12% gives you 4% W1. So if you make W1 the subject of your equation, it's going to be 3% by 4%, which means 3 by 4, which further means 75%. Mean the proportion of security 1 is 75% and 2 would clearly be 25. So that gives you C to be the correct option. Okay, now the next part, question 30th. If the correlation of returns between the 2 securities is negative 0.15, the expected standard deviation of an equal weighted portfolio, that is 50% security 1, 50% security 2, is closest to. So this is the formula we use. Just let's plug in the numbers. Okay. So the weight of security 1 is 50%. So we're going to write just 0.5 squared. Then the standard deviation of security 1 is 20%. So you can just 0.2 squared plus weight 2, that is again 0.5 squared, 0.2 squared plus 2 times of weight 1, 0.5, 0.5 times we have been given the correlation coefficient, which is negative 0.15 times the standard deviation of security 1, 20%, and the standard deviation of security. The rest of it is simply simplification. So when you do, you will get 13.04%. That is A. Okay, the next part says if the securities are uncorrelated, and there is no correlation, the expected standard deviation of an equal weighted portfolio is closest to. This is the formula. Since there is no correlation, so this correlation coefficient would be 0. Everything else being same, so you are going to simply replace negative 0.15 with 0, which means the only factor that is relevant, all this is gone. So you will just take these to get your answer. That is 0.5 squared times 20% squared plus 0.5 squared plus into 0.20 squared, and once you simplify, it should give you 14.14%, and that makes B to be the correct option. Okay, next question says, as the number of assets in an equally weighted portfolio increases, number of assets in equally weighted portfolio increases, the contribution of each individual asset's variance to the volatility of the portfolio would decrease. That's a fairly straightforward question. If the number of securities increase, so their relative proportion would decrease. So their contribution of individuals' variance to the volatility of portfolio, it would also decrease. So that's a fairly straightforward question. B is the right answer. Then, with respect to an equally weighted portfolio made up of a large number of assets, which of the following contributes the most to the volatility of the portfolio? Average variance of the individual assets? No. The average covariance between all pairs of assets. The co-movement is what contributes the most to the volatility of the portfolio. Fairly straightforward question. C is the answer. Next, the correlation between assets in a two-asset portfolio increases during market decline. So increase in correlation mean now these assets are now move in the same direction, side by side. So if there is no change in the proportion of each asset held in the portfolio or the expected standard deviation of the individual assets, the volatility of the portfolio is most likely increased, because now they are tending to move together. Correlation has increased. So this would overall increase the volatility of the portfolio. So that makes A to be the correct option. A it is. The following information relates to question 35 to 37. An analyst has made the following return projections for each of the three possible outcomes with an equal likelihood of occurrence. Asset 1, 2, 3, and these are the possible outcomes and the expected return. Which pair of asset is perfectly negatively correlated? Let's see for asset 1, when the asset returns fall by 12, the return on assets 2 fall by 6%, and for asset 3 it increased by 6%. And further, 0 to 6 is plus 6, it's minus 6, and then for asset 3 it's plus 6. Just look at this. 2 and 3, they move in the opposite direction. Minus 6 plus 6, minus 6 plus 6. right? So which pair of assets is perfectly negatively correlated? Look no further, asset 2 and 3. Next question 36. If the analyst constructs two assets portfolios that are equally weighted, which pair of asset has the lowest expected standard deviation? We have just learned that the asset 2 and 3, they are perfectly negatively correlated. So combining these will lower the risk. It will offer the lowest expected standard deviation. So we will compose these 2 and 3 in our portfolios. That makes C to be the correct option. Next. So if the analyst constructs two assets portfolios that are equally weighted, which pair of assets provides the least amount of risk reduction? So here we go. These are the 3 assets available with the markings. So as you can see, asset 1 and asset 2, they have the highest level of volatility of the 3 pairs. So if you combine 1 and 2, it would result in the least amount of risk reduction. So it's going to be asset 1 and 2 in question number 37. Asset 1 and asset 2, A is the right answer. Which of the following statements is least accurate? Mind the word. Least accurate. The efficient frontier is the set of all attainable risky assets with the highest expected return for a given level of risk. This is true. Lowest amount of risk for a given level of return. This is true as well. This is true. The highest expected return relative to the risk-free rate. This is incorrect. Efficient frontier, it does not account for the risk-free rate. Let me show you. See, this is your efficient frontier here. It shows you the set of all attainable risky assets with the highest expected return for a given level of risk, or conversely speaking, the lowest amount of risk for a given level of return. So that makes A and B to be the correct and C to be incorrect. Since we are looking for the incorrect one or the least accurate one, C is the right answer. C is the correct option. Then the portfolio on the minimum variance frontier with the lowest standard deviation is unattainable, the optimal risky portfolio, the global minimum variance portfolio. Let me show you from where we can do this question. This is it. This is it. Global minimum variance portfolio. As you can see, it's at the lowest standard deviation. So the global minimum variance portfolio is the portfolio on the minimum variance frontier with the lowest, as you can see, lowest standard deviation. So the portfolio on the minimum variance frontier with the lowest standard deviation is the global minimum variance portfolio. Not unattainable, it is attainable. And then this option B, the global minimum variance portfolio, is not the optimal risky portfolio if the risk-free asset is considered. So that makes C to be the correct option. Okay, next question. The set of portfolios on the minimum variance frontier that dominates all sets of portfolio below the global minimum variance portfolio is Markowitz efficient frontier. This is the one here. So remember, Markowitz efficient frontier has higher rates of return for a given level of risk. So with respect to this global minimum variance portfolio, the Markowitz efficient frontier is a set of portfolios above the global minimum variance portfolio. So these portfolios, they dominate the portfolios below this global minimum variance portfolio. So that makes B to be the correct option. B, Markowitz efficient frontier, that's the answer. Next, the dominant capital allocation line is the combination of risk-free asset and the optimal risky portfolios. We have just done a question like this in our previous questions. A is the correct option. Then, compared to the efficient frontier of risky assets, the dominant capital allocation line has higher rates of return for the level of risk greater than the optimal risk portfolio because of the investor's ability to borrow. So fairly straightforward questions from your overview video. It's because the investor can purchase additional amounts of optimal risky portfolio by borrowing at a risk-free rate. So that's B. B is the correct option. With respect to the mean variance theory, the optimal portfolio is determined by each individual investor's not risk-free rate, not borrowing rate, rather risk preference. Each individual investor optimal mix of the risk-free asset and the optimal risky asset is determined by the investor's risk preference, and that makes C to be the correct option, and it ends your EOC's portfolio risk and return part 1.